When it comes to investing in crypto, timing the market can feel almost impossible. Prices swing up and down so quickly that many investors ask themselves, should I wait for the dip or just dive in now? That's where a strategy called dollar cost averaging, or DCA, comes in. In this video, we'll break down what DCA is, how it works, why so many investors use it, and most importantly, whether it really works in crypto. Let's start simple. Dollar cost averaging is an investment strategy where instead of putting all your money in at once, you spread it out into smaller, regular purchases over time. For example, let's say you decide to invest $100 every week into Bitcoin, no matter the price. Some weeks you'll buy at a high, other weeks you'll buy at a low. Over time, those purchases average out, reducing the impact of short-term volatility. This steady, disciplined approach is designed to take the guesswork and the stress out of trying to time the market. Crypto is one of the most volatile markets out there. Prices can change dramatically in just hours or days. That's why many investors prefer DCA. It helps them avoid emotional decisions. Instead of worrying, should I buy now or later, they just stick to their schedule and let the strategy do the work. It also builds consistency. Think of it like setting aside money into a savings account. By automating or committing to a regular plan, you slowly build a position without feeling pressured to go all in at the wrong time. Now, the big question, does DCA actually work in crypto? Well, it depends on how you define work. Historically, for assets like Bitcoin, which has shown long-term growth despite short-term swings, DCA has been a strong strategy. If you had bought a fixed amount of Bitcoin every month over the past few years, your average cost per coin would likely be much lower than trying to guess the perfect entry point. But here's the key, DCA is not about maximizing profits. It's about minimizing risk. By spreading out your investments, you reduce the chance of putting all your money in at a peak. So while you might not catch the absolute lowest price, you also won't get burned by buying everything at the top. Of course, no strategy is perfect. DCA works best with assets that tend to grow over the long term. If you're dollar cost averaging into a project that doesn't survive or loses value over time, then averaging down won't help. It's also not ideal if you're chasing quick profits. Since DCA is a slow and steady approach, it's more about long-term confidence in crypto rather than short-term speculation. And that's it. If you found this video helpful, like and subscribe for more crypto content and let us know, are you using DCA in your crypto strategy, or do you prefer another approach?